When you picture a financial crisis, what do you see? Probably panic on the trading floor, right? Headlines flashing red everywhere. But what if I told you that's not the beginning of the story? What if that's actually the end?
And that right there, that single idea changes everything. This belief we all have that a crisis begins with a big, loud crash, it's just plain wrong.
Okay, so if it doesn't start with a bang, how does it begin? Well, it starts silently. It creeps in when no one is watching, long before the headlines ever get a whiff of what's happening. On one side, you have the myth, right? The drama, the panic selling, those huge red candles on the charts we all know. But the reality? Well, it's so much quieter. It's this silent stress that builds up inside the system. It's as simple as there just being fewer buyers, or credit starting to move a little bit slower. There are no alarms, no big announcements, just this creeping tension that almost nobody notices. And this all comes down to one absolutely critical word: liquidity. And listen, it's more than just the amount of money floating around. It's really a measure of confidence. It's that collective belief that you can sell what you own or borrow what you need without causing a total meltdown. When that confidence is high, the whole system just feels unshakable.
But when that confidence, that liquidity starts to contract, really weird things start to happen. Good news comes out and prices don't even budge. Bids for assets can just vanish without any warning. And volatility, which everyone thought was a thing of the past, comes roaring back with a vengeance.
And look, this isn't just some abstract theory. It's a pattern. It's a script that has played out over and over and over again. Seriously, every major market event you can think of has followed this exact same playbook. Just think about it. Back in 2008, long before most of us had ever heard the name Lehman Brothers, liquidity was already evaporating behind the scenes. In 2011, before the European debt crisis was on the front page of every paper, their markets were already cracking from the inside. And yep, in 2020, those critical funding markets completely froze up before the real lockdown panic hammered the stock market.
And that is the great deception. In every single one of these examples, asset prices were still high, public confidence was strong. Everyday investors were still all in, feeling totally secure right up until the moment the floor completely disappeared from under them.
It just goes to show it's not the news event. It's not the bank failure. It's not the pandemic, the withdrawal of liquidity that is always the first domino to fall. Which, of course, brings us to today. Because this same pattern is unfolding right now, but this time, you could argue the stakes are even higher. The whole system is just carrying a lot more weight, which makes it that much more fragile. I mean, just look under the hood. We're sitting on record levels of global debt. Government deficits aren't some temporary fix anymore. They are structurally part of the system. Corporations are staring down a huge wall of debt they have to refinance at much higher rates. And on top of all that, consumers are leveraged to the hilt at some of the highest borrowing costs we've seen in years. There is just no room for error. And to make things even trickier, there's been this subtle but profound shift in policy. Central banks, they're not really focused on stimulating growth anymore. Their new priority is control. And that means they're quietly tightening credit, shrinking their balance sheets, and basically reducing the amount of oxygen in the system, all without making any big, flashy announcements. And you know what? The stress is already showing up if you know where to look. Credit spreads, that's basically the risk premium on debt, they're getting wider. The cost for big institutions to fund their operations is going up. Even the supposedly safest treasury auctions are showing signs of instability. And banks, they're making it harder and harder for pretty much everyone to get a loan. These aren't just random data points. These are the warning signals flashing. So we've had this quiet phase, this silent erosion. But what happens when the quiet finally ends? It's not a slow, gentle decline. It's a sudden, mechanical process. It's like a switch gets flipped. And here is the great paradox of it all. That moment of maximum confidence, when everything feels great and asset prices are still near their highs. That's often the exact moment just before liquidity completely vanishes. This illusion of calm is what makes the drop so shocking when it comes. This process, it unfolds in 4 pretty clear steps. First, the pool of potential buyers starts to thin out, but quietly. Second, prices stay high, creating that false sense of security we just talked about. Third, some single trigger, could be anything, a failed auction, a political shock, causes all the bids to just disappear, all at once. And that leads to step 4, the gap down. Markets don't slide gracefully. They drop instantly, opening way lower than where they closed. It's not chaos, it's just mechanics.
At that very moment, the entire psychology of the market just flips. Capital stops speculating, stops chasing those high returns. Instead, it begins a desperate, frantic search for certainty, for safety, for anything that feels real and secure.
Now, the point of all this isn't to predict a crash for next Tuesday. It's a framework. It's about being aware. It's about understanding that right now, risk is being completely mispriced because that invisible foundation of liquidity is already getting weaker by the day.
So we'll end with this. Volatility is going to return. It always does. The real question is, were you paying attention during the silence? Did you recognize the signs of this quiet phase before all the noise began? Because by the time the headlines hit, the most important domino has already fallen.